Hi everyone. In this video, I'm going to debrief the practice questions on chapter number 2, Conceptual Framework. So practice OT revision questions, chapter 2, Conceptual Framework. We have 13 questions to practice. So I'm starting the objective type revision questions, chapter number 2, Conceptual Framework practice. The first question, which of the following is an underlying assumption identified in IFRS conceptual framework for financial reporting? Neutrality, accrual accounting, relevance, going concern. You know the answer, pretty much straightforward, going concern. Moving on to the second question, identify by clicking on the relevant box in the table below whether each of the following statements regarding financial information is true or false. The first one, faithful representation, means that legal form of a transaction must be reflected in financial statement regardless of economic substance. That is false. We have learned faithful representation means economic substance is important, not legal form. This statement says that legal form is important, not economic substance. That is wrong. Faithful representation means economic substance is important, not legal form. So statement number 1 is false. Statement number 2, only items that can be depicted by a monetary amount can be recognized in SOFP or statement of financial performance. Statement of financial performance means statement of P&L. That is true. We can only show an item that can be recorded in monetary item. Only monetary item will be recorded in SOFP as well as SOPL. You know that it is true. That concept is actually known as money measurement principle. The third one, it may sometimes be necessary to exclude information that is relevant and reliable from financial statement because it is too difficult for some users to understand. That is false. We have learned that an element must be recognized in financial statement if it is relevant, reliable, and faithfully represented. You cannot remove irrelevant information. You cannot remove a reliable information. You cannot remove a useful information. You cannot remove a faithful representation from financial statement. If an item is relevant, if an item is reliable, if an item is useful, if an item is faithful, then that item, that element, that asset, that liability, that equity, that expense, or that income should be recorded. You cannot remove it simply saying that it is too difficult for some users to understand. That statement is false. The last statement number 4, information is material if it exceed a quantitative threshold. Any transaction that does not exceed that threshold does not need to be disclosed. That is again false. We have learned what is material. And information is material if its omission or misstatement affect the economic decision of users of financial statement. It has nothing to do with a quantity or quantitative threshold. Quantitative threshold means, let's say that if an item is 3% of asset, or if an item is above $5,000, it is material. An item below $5,000 will not be material. Putting a quantitative threshold and saying that any amount below this quantitative threshold or below this amount is not material. No, that is not the definition of materiality. We have learned the definition of materiality, and information is material if its omission or misstatement will affect the economic decision of users of financial statement. It has nothing to do with quantity. So statement number 1 is false. Statement number 2 is true. Statement number 3 and 4 is false. Let's see whether the answer is correct. Of course, yes, it's correct. It's everything is showing in green. Our answer is correct. Moving on to the third question. Identify by clicking on relevant box in the table below which of the following statement regarding IFRS conceptual framework for financial reporting is correct or incorrect. Money measurement concept require all asset and liabilities to be accounted at original historical cost. That is wrong. Money measurement concept says that every item that we record in SOFP or SOPL should be measured in monetary term. It should be a amount. That can be historical cost, that can be fair value as well. So monetary money measurement concept does not say that you have to show a particular item at cost. No, it says that you have to show it at a particular amount. It should be expressed in monetary term. So statement number one is incorrect. Statement number two, faithful representation means that commercial effect of a transaction should be reflected in financial statement, not necessarily its legal form. That is correct. That is the definition of faithful representation. Faithful representation means economic substance is important, that is commercial effect is important, not legal form. Statement number two is correct. Moving on to the last statement, statement number three, concept of materiality considers only the decision that primary users may take based on financial information about specific reporting entity. That is correct. Materiality means that information is material because if there's a misstatement or omission in information, if it affects the economic decision of users, that is material. So definitely materiality only considers the decision made by the primary users or shareholders of a company. That statement is correct. So statement number one is incorrect. Statement number two and three are correct. Let's see whether it is correct or not. Of course, it is correct. Everything is in green. So moving on to the fourth question. IFRS 13 fair value measurement set out a fair value hierarchy that categorizes input into valuation techniques into three levels. We have learned level 1 input, level 2 input, and level 3 input. The question is asking which of the following input would be classified as a level 1 input. We have learned that level 1 input means quoted price or active market or market price. So option A, unobservable input, no, that is level 3. Directly observable input other than quoted price, that is again wrong because level 1 is quoted price, it's market price. See, quoted price in active market at the measurement date. Of course, yes, that is the correct one. Market corroborated input, no. So option C is level 1, quoted price, market price in active market. Confirming, and our answer is correct. Now, question number 5, IFRS conceptual framework for financial reporting identify qualitative characteristics of financial statement. Which two of the following are fundamental qualitative characteristics? That's pretty much straightforward. Relevance and faithful representation are fundamental qualitative characteristics. Understandability, comparability are enhancing characteristics. So moving on to the sixth question. Sixth question is not actually related to conceptual framework. It is related to trade receivables and factoring. If you have attended my classes at Kaplan School of Accountancy and Management, Kerala's first platinum approved learning provider, you know that this particular topic I have explained in chapter number 5, IFRS 15, revenue. So I'm not explaining this again for the benefit of my students at Kaplan School of Accountancy and Management. So skipping that. Seventh question is again, we have discussed this in my class at Kaplan School of Accountancy and Management. It is again related to factoring arrangement. So I'm skipping that particular item as well. Moving on to chapter number 8, the factoring arrangement. I have explained it in my classes at Kaplan's. And chapter number 5, IFRS 15 revenue, that is already covered in my class at Kaplan's. So I'm not explaining this particular topic. So the eighth question, which is related to conceptual framework, which two of the following are required to meet comparability characteristics of useful information? We have learned that comparability means you should be able to compare with previous year and it should be able to compare with industry average by disclosing information in notes to financial statement. So which two of the following are required to meet comparability characteristics? Option A, entities are required to disclose their accounting policy. Yes, we have learned that if you have to compare with another company, if you have to compare with industry average, entities should disclose their accounting policy. So disclosing accounting policy increases comparability. Corresponding information is required to be provided in financial statement. Yes, corresponding information means previous year information should be provided. And you know that in real world, in practical world, SOFP of current year figures and just next to it, Previous year figures will also be given. In profit and loss account, current year figures as well as previous year figures will be given. That previous year figures is known as corresponding figures. So corresponding figures are given in financial statement for comparative purpose. So we got the answer A and B. But let's discuss why C is not the answer and why D is not the answer. Statement C says that entity must use the same accounting policies from period to period. That is wrong. I have told you when we discuss this conceptual framework comparability in my class, which is available in this YouTube channel. I told you comparability means it should be consistent with previous year, but consistency does not mean uniformity. Consistency does not mean you have to follow same as previous year. You can change it. You can change from straight line method to reducing balance method. You can change from FIFO to average cost method. You can change from cost model to fair value model. Consistency is no, uniformity is not required. You can change if criteria mentioned in chapter number 4, IAS 8, changes in accounting policy, changes in accounting estimate, and prior period error are met. So there is no need for uniformity, and there is no need for entity using same accounting policies from period to period. It can be changed if criteria as per IAS 8, chapter number 4 is met. Option D, all assets within a class should be depreciated at the same rate. No, it can be different. They will have different useful life. Depreciation is based on useful life of the asset. So D is wrong. So for the purpose of comparability, entities are required to disclose their accounting policy and previous year information, that is corresponding information, should be shown in financial statement, confirming our answer is correct. Moving on to the ninth question. In accordance with conceptual framework for financial reporting of International Accounting Standards Board, which of the following is or are true or false in relation to enhancing characteristics of comparability? So which of the following is true regarding comparability? Statement number 1, permitting alternative accounting treatment for the same economic phenomenon enhances comparability. That is false. Having alternative accounting treatment does not improve comparability. It actually reduces comparability. Comparability require uniformity. Statement number 2, that is false. I told you consistency should be there, but consistency with previous year does not exactly mean uniformity. You can change from previous year if conditions that has been stated in chapter number 4, IASA, changes in accounting policy, changes in accounting estimates are met. You can change. It does not require uniformity. So both the statements are false. Moving forward to the 10th one. Which of the following meets the recognition criteria for an asset and or a liability? So is it an asset? Is it a liability, or is it both? Let's look into one by one. Green company spent 100,000 providing health and safety training to its staff. You know that training cost is not an asset, training cost is not a liability, training cost is an expense. So A is not the, sorry, 1 is not the answer. So since 1 is not the answer, we can remove A from the equation. Second one, Green has been told by a brand consultancy that the value of its internally created brand is 2 million. You know that internally generated brand or goodwill cannot be recorded. Even if it is being informed by an external agency, it's still internally generated. It is still self-generated. Self-generated goodwill, self-generated brand, self-generated customer list is not an asset, is not an intangible asset. So 1 and 2 is not the answer. So we can remove option A, 1 and 2. That is not the answer. The third one, Green company is suing a supplier for $450,000 for the losses that it suffered due to faulty goods. Green is likely, though not certain, to win the court case. So Green is suing a supplier. So if Green win, Green will receive 450,000. So it's an inflow. And Green is likely not certain to win the case. So likely not certain means probable. There is less than 50% chance of Green winning this case. So there is possible inflow. Less than 50% chance means possible. Likely not certain means possible. It's not probable. There is only less than 50% chance that it is possible inflow. You know that we have learned in IAS 37 provisions, contingent liability and contingent asset. If there is possible inflow, if there is less than 50% chance possible inflow, then it is disclosed as a contingent asset in notes. It's not an asset, it is disclosed. So 3 is not the answer. So we can say since 3 is not the answer, we can now remove B also from the equation. So what about the fourth one? Green company has sold goods subject to a 5-year warranty on which it expects to some claims will be made. So there's a warranty. So we have again learned this in chapter number, I don't remember the chapter. We have learned this in IAS 37, provisions, contingent liability and contingent asset. If there is warranty, a provision should be recorded, and provision is definitely a liability. So which of the following is an asset? There is no asset, or a liability. Yes, definitely there's a liability. That's the fourth one, the warranty provision. Provision is a liability. So option D would be the answer. The warranty provision is a liability. So moving forward to the 11th one, this is a past exam question as well. According to conceptual framework for financial reporting, verifiability means that different knowledgeable and independent observers could reach a consensus of faithful representation. Which of the following procedure directly verifies that relevant balances are faithfully represented? Confirming cash balance by conducting a physical count of cash, direct answer. If you have attended or if you have watched my previous videos on conceptual framework, when I explain verifiability, I've told you there is direct verification and indirect verification. Direct verification means shareholders going and directly verifying. Example, physical verification of cash is a direct verification. That is our question. Straightforward option A. Indirect verification is using formulas, is using models to verify whether the value given in financial statement is correct or not. So that is indirect verification. The question was asking direct verification, physical verification of cash, direct answer. Moving forward to the 12th question. Which of the following is not included in IASB definition of an asset in conceptual framework? So you have to remember the definition of an asset. If you have watched my video on conceptual framework where I have explained the definitions of asset, I have asked you to remember the definition of asset. It will be discussed during the question practice. Now, if you remember that asset is a present economic resource controlled by the entity as a result of past event. So asset is controlled by the entity. That is the definition of an asset. Asset is a present economic resource. That is also definition of an asset. An asset exists as a result of past event. That is also a definition of an asset. So A, B, and D are part of definition of an asset. The question is asking which of the following is not part of definition of an asset. Option C, economic resource can be reliably measured. That is not there in the definition of an asset. And the last question, which two of the following statements are true regarding conceptual framework for financial reporting of IASB? It's a principle-based rather than rule-based, but it is not an IFRS accounting standard. That is true. If you remember my discussion in my YouTube channel itself regarding conceptual framework, I've explained what is principle-based and what is rule-based. Principle-based is based on certain principles, and I've told you our IAS and conceptual framework are based on principles, not rule. And conceptual framework is not an IFRS standard, so statement A is correct. The B statement, the principles contained in conceptual framework overrides any IFRS accounting standard. That is wrong. Conceptual framework does not override accounting standard. If accounting standards state a particular treatment, then you have to follow the accounting standards. That is IAS and IFRS has number one preference, not conceptual framework. Conceptual framework does not override accounting standard. That is wrong. C, it requires accountant to evaluate and address threat to compliance with ethical principle. That is absolutely wrong. Conceptual framework has nothing to do with ethics. So if B and D, C is not the answer, then the two will be A and D. Let's discuss about D. If it is revised, it will not automatically lead to changes to IFRS accounting standards. That is true. If conceptual framework is revised, it doesn't revise accounting standards. So now I have completed all the discussions regarding conceptual framework in 7 parts. In first 5 parts, I have completed the entire syllabus of conceptual framework that is there in chapter number 2 of ACCA Study Hub. And part number 6 and part number 7, we have discussed Qs and OT revision questions from ACCA Study Hub. So thank you everyone. All the best for your FR examination.